this continued expansion from here is highly reliant on households continuing their consumption. So they need to continue to get the income from from employment, and they need to continue to spend out of that income growth in order to keep nominal growth continuing. And we've been in the last couple of years, we've been kind of in this holding pattern where labor markets have been tight enough to create enough wage growth, to create enough nominal spending growth, and asset prices have continued to rise enough to keep households running, a savings rate which is certainly below where it was pre-COVID, not falling rapidly, but this is not a particularly elevated savings rate. And that creates a lot of fragility because essentially, if the income side of the equation falters at all, particularly from those more cyclically sensitive sectors, then you have a risk that the income coming in, the income growth that's coming in, will slow, which will put a weight on household incomes. And similarly, it highlights the fact that continued household demand at these levels is very reliant on continued asset price appreciation. The reason why households have been comfortable essentially spending 100% of their income growth on an ongoing basis is because asset prices have kept going up, which meant that the incremental need to save has not been that high, right? If your stocks are going up, your 401k is going up 25% a year, and your house price is going up, 10% a year, you don't have the impetus to save as much as if those asset prices are not going up in that way. And so this economy is very levered implicitly to a continuation of rising asset prices to maintain the household spending that we're seeing, which is being financed by the continuation of tight labor markets and income growth. And so you put that all together, and in a lot of ways, expectations are very high for growth. The only source of growth at this point is coming from household consumption. Household consumption is reliant on continued strong asset prices, and strong asset prices are really reliant on not having bond yields rise too much. And that is the challenge with what we're seeing right now, which is that all of what you're seeing today is a set of dynamics that were in motion in the data. What you're seeing today in the data is a set of dynamics that were in motion set about 3 to 6 months ago when it comes to hiring, spending, etc. But since that was set in motion, we've had over the course of the last 6 or 8 weeks more than 100 basis points rise in interest rates. We've effectively had 100 basis point plus market-based tightening, which is yet to flow through and yet to be seen in the underlying stats. And so that's what I'd emphasize, is that we're seeing the maximum exuberance in terms of asset prices of future economic conditions just at the time when we're starting to see, we've experienced one of the largest market-based tightenings over the course of the last couple of years.